Learning Objective 2 is to compute the direct labor rate and efficiency variances and explain their significance. Let's continue Glacier Peak Outfitters example. The company has the following direct labor standard for its mountain parka. 1.2 standard hours per parka at $10 per hour. Last month, employees actually worked 2,500 hours at a total labor cost of $26,250 to make 2,000 parkas. Compute labor rate and efficiency variances. Let's follow the model to calculate labor variances. Column 1, standard hours multiplied by standard rate. Standard hours are based on actual output, 2,000 parkas. For each parka, it requires 1.2 hours. So we can calculate the total standard hours to produce 2,000 parkas. 1.2 hours multiplied by 2,000 parkas, and we can get 2,400 hours. Standard rate, $10 per hour. So we can calculate total flexible budget cost, $24,000. Column 2, actual hours times standard rate. Actual hours. If you go back, take a look at the previous slide. Employees actually worked 2,500 hours. So we use 2,500 hours multiplied by $10 per hour, and we can get $25,000. Column 3, actual hours times actual rate. This is actual cost. So go back, take a look at the previous slide. The company has spent actual cost, $26,250, and we can just put this number under column 3. But if we want to know the details, we need to calculate actual rate for each hour because the question does not tell us. To calculate the actual rate, we use total actual cost, $26,250, divided by actual hours, 2,500. And we can get $10.50 per hour. And now we can calculate labor efficiency variance and labor rate variance. The labor efficiency variance, defined as the difference between the actual quantity of labor hours and the quantity allowed according to the standard, is 1,000 unfavorable. It's labeled as unfavorable because actual quantity of hours is more than the standard quantity of hours allowed. Labor rate variance, defined as the difference between the actual average hourly wage paid and the standard hourly wage, is $1,250 unfavorable. It's labeled as unfavorable because the actual average wage rate is more than standard wage rate. We can also calculate the labor variances following equations. To calculate the labor efficiency variance, we use actual hours times the standard rate minus the standard hours times standard rate. And we can calculate it using numbers here. We will get 1,000 unfavorable. To calculate the labor rate variance, we use actual hours multiplied by actual rate minus actual hours multiplied by standard rate. And then we can get $1,250 unfavorable. Generally speaking, labor variances are partially controllable by employees within production department. For example, production manager can assign highly skilled workers and less skilled workers to tasks which are consistent with their skill levels. The production manager can motivate employees. The production manager can provide good quality of production supervision and also provide training to employees. But sometimes, labor variances cannot be controlled entirely by the production manager. For example, the purchasing manager may purchase lower quality low materials, resulting in unfavorable labor efficiency variance for the production manager. Or the maintenance department may do a poor job of maintaining production equipment, and this increases the processing time required for each unit, and causing an unfavorable labor efficiency variance. After the second conversation, obviously, those two managers will be more mad at each other. Learning objective 3 is to compute the variable manufacturing overhead rate and efficiency variances and explain their significance. Before we take a look at example, let's refresh our memory. For quantity variance and price variance, the calculation for materials, labor, and the variable manufacturing overhead is the same, but in different names. For materials, we still use quantity variance and price variance. But for labor and variable manufacturing overhead, we name variances as efficiency variance and rate variance. Let's just take a look at example how to calculate variable manufacturing overhead variances. I'll just call it variable MO variances. Glacier Peak Outfitters has the following direct variable MO labor standard for its mountain parka: 1.2 standard hours per parka at $4 per hour. Last month, employees actually worked 2,500 hours to make 2,000 parkas. Actual variable MO for the month was 10,500. Compute variable MO efficiency and rate variances. Here, please note, the allocation base for Glacier Peak Outfitters MO is standard hour. $4 per hour is variable part of predetermined overhead rate. Let's take a look at the calculation. Following the model, column 1, standard hours times standard rate. We first calculate the standard hours allowed for actual output, 2,000 parkas. We use 1.2 hours per parka times 2,000 parkas, and we can get 2,400 hours. Standard rate for variable MO is $4 per hour. So we can calculate 2,400 hours times $4 per hour. Total flexible budget cost for variable MO is $9,600. Column 2, actual hours times standard rate. The question has told us employees actually worked 2,500 hours to make 2,000 parkas. So actual hours, 2,500 hours, multiplied by standard rate, $4 per hour, and we can get $10,000. Column 3, actual hours times actual rate. This is actual cost for variable MO. Go back, take a look at here. Actual variable MO for the month was 10,500, and this is a total number. If you want to get the details, we need to calculate the actual rate. We use total variable MO cost, 10,500, divided by total actual hours, 2,500. And we can get actual rate for variable MO. This is $4.20 per hour. If we use actual hours times actual rate, 2,500 hours times $4.20 per hour, and we can also get the total variable MO cost, $10,500. Now let's take a look at variable MO efficiency variance and rate variance. The variable overhead efficiency variance defined as the difference between the actual activity of a period and the standard activity allowed, multiplied by the variable part of the predetermined overhead rate, is $400 unfavorable. This is labeled as unfavorable because actual quantity of the activity, here in hours, is more than the standard hours allowed. The variable MO rate variance, defined as the difference between the actual variable overhead cost incurred during the period and the standard cost which should have been incurred based on the actual activity of a period, is 500 unfavorable. The rate variance is unfavorable because the actual variable overhead rate is more than the standard variable overhead rate. We can also calculate the variable MO variances using equations. To calculate the variable MO efficiency variance, we use actual hours times standard rate minus standard hours times standard rate. We put the numbers here and then we can get 400 unfavorable. To calculate variable MO rate variance, we use actual hours times actual rate minus actual hours times standard rate, and then we can get 500 unfavorable. So far, when we calculate variances, we assume all materials purchased in a period are used in the production process that period. But what if materials purchased in a period are not all used in the production process in that period? Then quantity variance is calculated only based on the quantity used. Price variance is computed on the entire quantity purchased. Let's see the calculation. Glacier Peak Outfitters has the following direct material standard for the fiber fill in its mountain parka. Information here is same. 0.1 kilogram of fiber fill per parka at $5 per kilogram. Last month, 210 kilograms of fiber fill were purchased at cost of $1,029. Glacier used 200 kilograms to make 2,000 parkas. Compute materials quantity and price variances. Following our model, we calculate column 1, standard quantity multiplied by standard price. Standard quantity is based on actual output, so it's 0.1 kilogram per parka multiplied by 2,000 parkas, and we can get 200 kilograms. Standard price, $5 per kilogram. So we get the total here. This is a flexible budget cost for materials, $1,000. And now, when we calculate column 2, actual quantity times standard price. For actual quantity, we use quantity used. So you can see here, Glacier used 200 kilograms to make 2,000 parkas. We put 200 kilograms here, multiplied by standard price $5, and then we'll get the same number, $1,000. There is no difference between these two numbers, so quantity variance is 0. And now, when we calculate the price variance, we should use quantity purchased for actual quantity. So for column 2, actual quantity times standard price. The company has purchased 210 kilograms. So we use 210 kilograms multiplied by standard price, $5 per kilogram, and then we can get $1,050. For column 3, actual quantity and actual price. This is actual cost. So we can just use the number the question has told us, $1,029. This is the actual cost. And if we want to calculate the actual price, we can use total cost $1,029 divided by actual quantity And here, actual quantity, we should use quantity purchased, 210. Actual price is $4.90 per kilogram. If we use actual quantity, 210 kilograms, multiplied by $4.90 per kilogram, we can also get a number, $1,029. And now we can calculate the materials price variance. It's defined as the difference between what's paid for a quantity of materials and what should have been paid according to the standard. It's $21 favorable. The price variance is favorable because the actual price is less than the standard price for each kilogram. If we take a look at the whole picture, in this case, materials purchased are not all used in the production process in that period. Then spending variance does not equal quantity variance plus price variance, because column 3 we use quantity purchased, and in column 1 we use quantity used. This is end of chapter 10.